I'm now moderating this panel about something that is equally as interesting. What different kinds of financing are available and out there to founders? And I'm really excited to have some amazing founders today to talk about their fundraising journeys. So yeah, let's kick it off. I thought we could get started today by talking, maybe Elizabeth and Ahmed, you could actually talk us through introduce your businesses, right? And then talk us through how you've approached fundraising, because both of you have different paths.
Sure. You start.
Yeah, sure. Happy to start. Hi, everyone. My name is Elizabeth, and I'm the founder of a company called Modularity Grid. We essentially build software to help engineers understand, predict, and optimize the health and the performance of energy systems. So this could be an energy system in a satellite or a microgrid, that sort of thing. And yeah, so that's me. So quick intro, and then our path.
Yep, your fundraising. How have you fundraised so far?
Okay, yeah. So I guess the path for us was very much about kind of getting that funding to mitigate certain risks. In our case, the sort of key risk coming in, with the sort of deep tech hat on was technology risk. And so one way to actually address that, especially in a context where you already understand the problem really deeply, and you have a very clear path as to that you need to follow. For us, it kind of just meant going for grant funding. So we went for an Innovate UK grant, and so rather than going through the pain and hassle of kind of drumming up kind of meetings with VCs and that sort of thing, we could just get stuck in with work and actually just building stuff, showing that stuff works. And then it sort of delays that VC conversation a lot more. So effectively, our seed round was largely a combination between grant funding and corporates chipping in.
Cool, amazing. Ahmed, do you want to talk to us?
Mine will be easy.
Yeah.
Papara is a challenger bank in Turkey, like Revolut, number 26, and many others. Haven't raised any funds yet. I'm proud to say it's a bootstrap unicorn.
So why have you been bootstrapped thus far?
That wasn't my first choice, actually. We couldn't raise any funds before.
Okay.
We tried to raise some funds at the end of the first year, actually. We started the company in 2016.
Okay.
At the end of the first year, we decided to raise some funds, but none of this Turkish or some European VCs agreed with the business model we have. They didn't believe that we can compete with banks in Turkey because banking technology in Turkey is actually better than US or Europe.
Okay.
So they didn't give us a chance. Then we had to be creative, look for profitability instead of growth, and build the company to $150 million in yearly revenue.
Amazing. So now I want to come to Asher. So I know that you guys have raised VC funding as a business, but I want you to talk today with your hat as kind of the representative of revenue-backed finance today. So can you tell us a little bit about what Uncapped does and what services it gives to companies and why that might be attractive as a fundraising strategy for a company?
Yeah, sure. I guess as well I would say to that, I've actually been a founder a few different times. This is the third company that I founded, and I've actually raised every type of capital prior to this. So I did, I bootstrapped, I raised debt, I had equity and angels, I did one of the largest crowdfunding rounds. So I had all these different experiences with raising funds. But I have to say the biggest challenge was always that. And I've just seen so much about how founders have really struggled with raising capital. And that was actually the inspiration for starting Uncapped. So, we founded Uncapped as Europe's first revenue-based finance provider. So we're a new way to fund a company's growth where we gave them equity and interest-free investments that start from 10K up to £5 million. And it gets repaid via a revenue share, hence revenue-based finance. So maybe a little bit of an example, if you wanted to say 100K, we would be able to deploy that to you, and then you'd pay a 6% fee on the capital. So at the end, you'd owe 106K, nothing more, nothing less. And you don't pay any other fees except for that flat fee. And get to basically get that capital really quickly, often in 24 hours, so that you can get back to running your business.
And what is your ideal customer? What kind of companies come to you?
Well, I would say Uncapped is great for you if you are doing at least 10K of monthly sales, if you have a growing business, and you have positive unit economics. So we've really seen the model work for a wide variety of businesses. from people who are bootstrapped to also people who have done a lot of VC capital and actually just want to grow in a more affordable way.
Super cool. Amazing. So maybe I want to come back to you, Elizabeth, and talk a little bit about how you thought through fundraising. What were the places that you got advice from? Who was helpful to you when you were thinking through this roadmap, which obviously also includes, what you're going to do in the future and approach fundraising in the future?
Yeah. So in terms of getting to that decision, we didn't really need kind of, I guess it was the reason why we needed the money. And in our case, it was for a very specific purpose, to do a very specific set of experiments that would help us answer a very specific set of questions. We knew exactly what we needed to do, how long it would take. And so that made grant funding ideal in that setting, because ultimately the sort of downside of grant, obviously the upside is that everyone would like to get non-dilutive funding, etc., right? But then the downside is that it is ultimately short-term funding. It's not long-term funding. It's tied. You're sort of contractually bound to a very specific set of targets, to a very specific timeline. And there's not much kind of flexibility there. There is to an extent, but the sort of bureaucracy, the sort of overpouring of a level of bureaucracy can make it really difficult to change once you've already committed to a path. But in our case, it was still ideal because we knew exactly what we needed to do, the problems that needed to be solved. So it just fit really well. And I guess for me, in terms of, because for my first company as well, in that context, we raised in excess of almost about $16 million, and it was mostly a combination between grant funding and development finance institution funding, right? Again, it was to do very specific things, and so kind of off the back of that, I knew that this was a model that would work for me this time around as well.
And would you have any advice to founders who are looking at grant funding? Like, are there any things to look out for? Yeah,
absolutely. So I would say the kind of key things would be, it's heavily bureaucratic. So there's the kind of upfront, first of all, upfront when you're applying, you do have to put a huge amount of effort into research and planning and having this kind of very clear roadmap. But then that's a good thing anyway, because if you're going to go ahead and execute on your project, surely it helps to have a clear sense of where you're going. So I would say that would be my counter argument to the whole it's a waste of time thing. And then when you actually get it, I suppose the downside is that there's a huge amount of admin work that you do need to do. So I'd say for something like that, just make sure you have a dedicated person in your team who'll be responsible for picking up all the sort of project management type stuff and admin. And then just to see it for what it is, which is short-term funding, and then bearing in mind that you still need to match it. And so because, especially if it's, let's say, kind of funding from the European Commission or from Innovate UK, it's never 100% of the costs that you need. You do have to match it, and you can't match it in kind or anything. Cash has to be in the bank. And so I would actually say, because a lot of people can kind of go, okay, I'll just remortgage my house. I was like, really resist that tempt, really resist that. But there's options. There are options. So there's you've just mentioned revenue-based financing. There's grant-backed financing. So you can get that, especially if you've got a government grant. Often they're able to then just kind of give you that upfront cash, and it deals with the sort of match funding thing. Or you can go to a VC. Yeah.
Makes sense. So Ahmed, could you talk us through a little bit more on the pros and cons of your path being a bootstrapped company? You said having basically no choice of VC forced you to be profitable, but have there been any other, have there been downsides or have there been any other positives for the business?
Being a bootstrap company sounds great if you are a founder, but it also has many disadvantages as well, which means that I have to add that VC money is not money only. and they always try to sell themselves like smart money. Sometimes it can be really smart, and I feel that a lot these days. So the thing is, after being bootstrapped, you have to focus on the product. You have to focus on profitability, which also brings creativity. So with VC money, you usually focus on the growth only. If your early investors are looking for it, and usually they look for it. But if you don't have that VC money, you have to focus and build something which is very profitable, right? Just to give you an example, our first version of our product, which looked like a challenger bank, actually was like the early days of PayPal. We had like tons of features there. But at the end of the first year, we have noticed that we had close to 600,000 users with no marketing, all viral. But we had no chance to monetize those users because we were only focusing on underbanked people in Turkey. And by underbanked, I mean people under the age of usually 22 or 23. But those guys don't spend money because they don't have money. So at the end of the day, you are praying like, a 17-year-old teenager needs to go to cinema, bring his girlfriend to a meal or something because they don't spend money. And then we found out that, it is difficult to monetize that users. We have to build something profitable. And to do it, we have to increase the total transaction volume on our platform. And to do it, the only way we could was actually targeting bank users and acquiring bank users directly instead of underbanked users. But in this time, you have to be more creative because you have to find something very strong, a stronger value proposition, because in this case, probably you will have higher return, but also higher customer acquisition costs. Then actually we did something very stupid, but right now it sounds amazing to me. We have decided to delete some of the features on the app. When we started, you could actually just pay your bills, small personal finance management tools, like tons of stuff were there. But then we found out that we cannot even monetize like more than 90% of those features. Then we have decided to find that specific feature that is possible to monetize and focus on that. And we have decided to delete all other features than that. That feature was actually quite, simple, like Cash App or Venmo. We used to enable people to send money to each other by choosing someone from their contact list. Then we have decided to use all the money we have to invest in that feature only, not marketing, only that feature, to make it better and better every day. And that feature actually makes more than 90% of our revenue today. So the advantage of being a bootstrap company is that you have to be creative all the time, and that vision actually just spreads over the company. So all of your employees has the same vision as well. And it is something very strong if you're a startup. But on the other side, the disadvantages are, there are many disadvantages. Just to name you some examples. The first thing is, there is no stamp there. So let's say that you have stock options for your employees, or you are trying to acquire some talent outside of your country when you are trying to make a global product or looking for expansion. But when you don't have that stamp, you cannot just send over your financials to everyone and tell them that you are a profitable bootstrap company. They are looking for a stamp, and that stamp is usually an investor. So someone needs to put a stamp there and make a fair evaluation for everyone, both for your investors, both for your employees and others. The second thing is, even if I don't like it, there are some rules in the world that you have to accept. Like we have, for example, Uber as one of our best users. If you are an Uber driver in Turkey, you will get paid into your Papara account, for example. Okay. But when you are trying to get in touch with more big accounts like that, like Airbnb and others, the first question they ask is, who backs you up, guys?
Interesting.
So even if you don't like it, this is the world, right? You have to find a solution. And the third, and maybe the biggest disadvantage of being a bootstrap company, is that you have to motivate yourself every morning. So there is no one pushing you. You are usually alone with your co-founders, and that motivating yourself every morning is something very difficult, actually.
That's super interesting. I think it's also interesting you touched on that, like, brand or that validation that VC can give you, right? So you can say, oh, I'm a unicorn company. Someone has said that I'm a unicorn. I've been in Sifted, right? You have been in Sifted. But I'd love to hear from you too, Asher, what you think about that branding, which comes around certain kinds of fundraising. Have you, like, what about in the world of debt? Like, how has the brand image of that changed as well?
Yeah, it's so interesting. For so long, I think so many entrepreneurs have seen the symbol of success as raising a big round and getting that coverage in Sifted, for example. And you can't blame them, right? Because you see those headlines consistently, and that's what people seem to be really focused on. But I've always really believed that like true success as an entrepreneur is actually about building a profitable business, and that's actually what we should be celebrating, even if it doesn't hit the headlines. And I think what we've tried to do at Uncapped is also just celebrate that and kind of recognize the founders that we've worked with and shown the success they've had and kind of elevate them to that same level, because it's actually incredible to see how much a company can grow. We really focus a lot on working with e-commerce businesses, for example, and it's actually phenomenal how you can take a really small group of people. Sometimes our customers have 5 people in their business, and they're able to generate millions of sales in a single month. And it's really because of the platforms and power that we have in our current world, of the tools we can use to achieve that. And those founders are owning more of their companies, and I think that's really actually what we should be thinking about as success.
And when founders come to you and they're considering, revenue-based financing, what are some of the questions that they're asking, and like how are they comparing it in their mind to VC?
It's funny, when we first launched revenue-based financing in Europe, it was people really just didn't understand that such a product could exist. I think the question I got from everyone would be, what's the catch? And trying to explain to them actually there wasn't a catch, and that really this product does what it said on the tin, I think was a really interesting dynamic. And I think since then we've just gotten many more examples of companies who are using the product and seeing a lot of success from different angles. Like one of our customers recently is a company called Headwind. And they were stuck in this same trap that I see like so many entrepreneurs, where they're a fashion company and they basically would have to wait until the current season would sell before they could actually invest those profits to be able to be in the next season. So they were just their growth was kind of like a step curve, where they're moving up step by step. And they started working with us, and they took a 50K advance, being really curious and questioning whether this thing is like, what is this? Is this going to work for us? And they reinvested that into their inventory and some Facebook marketing, and basically in the next quarter, they grew 11,000%. So kind of when you hear stories like that, you realize, what's the opportunity if there's all these companies where they have a great founder, they have a great idea, but they just can't access capital. And when you're able to shift that, you can just make a huge difference.
Super interesting. Elizabeth, I'd also like to talk to you about how you think about being a deep tech company, right? And the specific kind of, things that you need to consider being a deep tech company, and then thinking about fundraising. And I think when you introduced your company, you talked a little bit about that as well. There are like specific things that you need to prove as you build the business. Can you talk a little bit about your experience, and then maybe also what you've heard from other deep tech founders about how they're thinking through fundraising and what's specific about it in deep tech?
Yeah, absolutely. So I suppose in our case, fundamentally, if the sort of core value add is in the embedded software, then you sort of have to build the actual hardware that's associated it. So to actually be able to demonstrate that somehow, and often if you're talking about a microgrid. So this is kind of a power system that, kind of a system that kind of generates, stores, and distributes electricity for, let's say, a village, 200 homes, etc. You're going to have to build that and actually then put your software and then show the actual, and then actually kind of demonstrate that and show how it works. It gives you a chance to also understand the costs associated with actually doing that, and it helps you along your journey, basically hitting those key kind of de-risking and hitting key proof points. And I think for us, getting grant funding again was a great way to be able to take that risk, bring in, let's say, partners that could do certain bits that we didn't want to get bogged down focusing on. And then they were also covered in the kind of grant kind of umbrella, and they also got funding to do that. And so that meant that we ended up building this microgrid, demonstrating, getting the kind of proof points that we wanted. And that was kind of a great way to go in terms of just ticking those boxes. So we did that in one context. So we did it in Uganda. And then thereafter, because obviously their costs are super low, labor is super cheap. And then you get to then replicate it in a UK context where, costs go up, but then you've already de-risked certain key critical aspects. And so now you're replicating it and you're kind of just trying to prove something slightly different. So it's like not quite the commercial product yet, but you still have to build a system that can generate revenue. And it goes to what Ahmed was saying around, like, you really need to think about how you can leverage crowdfunding to bring you closer to generating revenue or to actually allow you to generate some early revenue. And so that was kind of our focus. And so you build out this system, you're generating some revenue from that, and you're able to kind of plow that back in as more matched funding for additional grants, or whether it means that actually just, actually into the R&D to be able to get closer to market. So that's kind of how we've been looking at it.
And if you were to raise from more traditional investors in the future, what would you be looking for?
Yeah, so I think I think at the moment, I think, it's inevitable at some point you've got to go to the VCs, I suppose. But you've got to make that move because you really want to scale, you really want to be able to drive things forward and do it fast, right? Because the downside of doing things the way we've been doing it is that it does slow you down, because you don't have any room to make mistakes. You kind of have to get it right first time. And so because you have to get it right first time, you have to put a lot more time and effort into it. I mean, I actually would argue that that's a good thing. You have to put a lot of effort into planning and, really making sure that execution is on point every single time. And so I would say now when going out to raise, we would be focusing primarily on kind of corporates. That kind of strategic funding is really, really valuable because they're getting more than just money back. They're getting potential kind of, all the additional kind of value add that will come to their business. And so that would mean that they would be great from that sort of standpoint, but also in terms of kind of key specific things that we want from them to do, whether it's in terms of opening up, kind of that stamp of approval that you mentioned, whether it's opening up links to their own customer base, etc., helping us to kind of bulldoze certain barriers with their kind of big corporate brands and stuff. That is super useful. And ultimately, on the VC side, I would expect from them to be a team that have already supported another similar deep tech through the journey and kind of reinvested in the team and kind of led the round, participated in follow-on rounds. I would also want to see them, kind of adding more value, because, ultimately cash is cheap. I've built a business that can be deep tech and profitable, so I want more. So I guess I kind of have the luxury of being able to wait a little bit longer and make sure that I choose the right partners also.
So I'd love to hear from you now, Ahmed, because I know you've said that you're looking to raise fundraising as you expand into Europe. So interesting, you're profitable, so you need more. Is that your approach to fundraising? And what do you want from your investors if you're going to raise money?
First of all, there's a great book of Alex Lazaro, which is called Unicorns versus Camels. So the reason why we will raise some funds is not that we will get some money and start to burn it and look for blitz scaling or covering all around the users in Turkey, blah blah. I don't believe in it. The thing is, we will raise some funds because of the issues that I mentioned, like governance, stamp, strategic help on building a global product. Because of that, actually, as soon as we issue common stocks, the only thing we are looking for is that investor has a good reputation, and also that investor can really help us by being hands-on. Actually, this is the only thing we are looking for. But on the other side, I have seen many friends of mine or many similar companies who are ruined by VCs. Because of that, I will probably look for the portfolio of the VC first, like you would do, and check if they have built challenger banks or good fintech products before. because fintech can be a bit tricky, by the way. You have to deal with regulators, you have to be compliant, and sometimes that compliance level is something not objective. Because of that, you have to argue on many products or many features you develop with your VCs, with the regulator and others. Because of that, you have to share the same mindset. And I think a good portfolio of challenger banks or VCs might help. Besides that, nothing particular actually.
So have you actually had some conversations, and what has kind of been the feedback if you have?
The thing is, you can call it like destiny or karma, whatever it is. If you are looking to raise any funds, there is no VC there. But if you are not looking for some money, there are like VCs coming to your office without getting an appointment. It happened to us like that, by the way. Like 5 years ago, we were trying to raise some funds. We couldn't reach out most of the VCs actually. But after that, after they have seen that you can do something by being creative and without having that much money on your balance sheet, and probably they start to believe in your story. And yeah, we are in touch with tens of VCs right now, tens of private equities, different types of investors. That's all I can tell you.
Cool. And how has, being from
I'm
Turkey,
not sure if they're going to watch it or not.
but,
They're good.
we've seen many Turkish startups raise lots of money recently.
Yeah,
How
that's
has,
great.
like, the brand of being from Turkey, how has that changed from when you were trying to fundraise before versus now?
It's like the fashion brand you are serving. Actually, it's like that, because Turkey is a tricky market. I'm not sure if you have seen what is going on with Turkish lira in the last 1 month. So it has been down by like almost 60% in 1 month. So it goes like that. Turkish lira performs well. You see some transactions in Turkey, and then there comes a Turkish unicorn. Then all of these, global big VCs are looking for Turkish market. Then Turkish lira goes down by 20%. There are no VCs for 6 months. And then they appear again. Blah, blah. That's a story like that. So it's not something only about Papara. It's also about Turkish market. It is good that companies like Getir is going to be a decacorn in a couple of weeks. Trendyol is already a decacorn. So it is great to show people that, with a population of 80 million people, you can create decacorns in a country where $1 is equal to 15 Turkish lira. It is good to show that, and it is the stamp of the country.
Yeah, definitely. So I'd love to hear from you, Asher, about maybe your personal experience. We heard from these two about like how they're thinking through fundraising. In all of your previous, entrepreneurial experiences, what were some of the things that you thought through when you were fundraising, and maybe what were some of the mistakes that you made?
Yeah, so with my first company, I did that back in '03. So I was in my 20s, and so I was quite young, and I was just trying to raise 100K, and I probably went to 100 different investors and got 100 no's. And I had this experience of thinking about raising capital in that way, and I didn't want to go to the banks because they all wanted personal guarantees, and I didn't own a home. And on the flip side, VC wasn't right for me because I didn't have those connections. I didn't have a warm intro. And so I really felt like I missed out on a lot of growth opportunities in those days. And then it was kind of funny, when I went to my second business, I thought I had it all figured out, and I raised millions in venture capital, but I also got terribly diluted. And I just, it was actually really depressing to think that I could work so hard and then own so little of my company. And, the stat was that, like 15%, that's how much the typical founder of a unicorn business will own at exit. And, I just saw that all around me. All the founders I knew were kind of in that same situation of where they'd have to either, debate, do I, get saddled with debt, or do I, go and, give away a huge chunk of my company? So kind of as I thought about those opportunities, I was always like searching for other things. I tried crowdfunding as well, and I did this massive crowdfunding round, which was a very very stressful experience, probably the most stressful funding experience that I've had, because I think it's interesting. It's much more inclusive. Crowdfunding can open you up to many more investors than you would perhaps in VC. But the stakes are really high because you have a target to hit, and it's all or nothing. And it's kind of funny, of course, if you don't succeed in VC, you can always go and knock on another VC's door. But in crowdfunding, if it doesn't go right, a failed crowdfunding round, it kind of says to investors, hey, either your execution or your business just isn't right. So, the consequences of failure are really dire. So we got through that. We raised the funding round then. I also took on some strategic investors. So it's interesting that you mentioned that, Elizabeth, because actually I think that is the biggest mistake I made at my last company. And strategic investors are this double-edged sword, where on one side, you think, oh my God, this guy really is going to understand my business. They're going to come into it. They're going to add all this value. But as soon as they enter your cap table, it means that for every other investor that's looking at that business and thinking about investing, they're wondering, well, what's going to happen at exit? Because any round that you go out and try and put to a potential acquirer, they're thinking the strategic investor is a stalking horse, right? And therefore, they're just trying to set a price internally, and that makes them lose interest. Those strategic investors can also block you. So an example I had a deal to sell the company for millions, but our strategic investor wanted the company for themselves, and so they wanted to push the price down. So they blocked every possible transaction for us to get out of the company until we fundamentally had to sell the business for a much lower value than we would have previously. So I think with strategic investors, it's not all like that. There's some of them that are great, but I think it can also be a really challenging situation for a lot of founders, and you got to be aware of those different options as much as you would think about, what are the challenges with VC. Bootstrapping, I loved hearing your story about bootstrapping, Ahmed, because I can really relate to that. When I was doing my first business, I was basically my biggest stress was, how do I make payroll? Because you gotta, as you said, you gotta execute and you gotta plan it really right. But I think the positive side, of course, is that you are creative, but also that it forces you to be smart about how you spend your money. It's so easy when companies get a lot of VC, they are just throwing that money around, and it can mean that they don't necessarily make the smartest choices about how to really build a great business. So I think the right answer is probably thinking about a combination of strategies and putting those together to ultimately get to the biggest outcome.
And also, you have white hair at the age of 30.
Absolutely.
Oh my gosh.
Well,
Someone asked earlier about founder trauma. I feel like we're treading into that territory again. We'd love to go to some questions now from the audience. Does anyone have a burning question? Someone up here in the second row has got their hand up. Amelie? Yeah.
Thank you. Thank you for the presentation. Asher, I cannot help but asking, really amazing job you've done there in Uncapped. If I get it right, you said we help companies from 10K monthly on revenue upwards.
That's right, yeah.
Isn't that a huge amount for a bootstrapped company? How do people get there?
Well, so I would say...
If not with an angel VC.
So 10K, and why we have that kind of as the number is because 10K is the point, if we are generating that monthly, you've moved from the business just being something that's side of desk to being something that you could actually make your living off of. And you're actually getting to that phase where actually you have something you can really scale. And our product, it's not seed funding. It's not for that very, very first beginning. It's money that basically adds more fuel to the fire without taking a piece of the pie. So for those businesses that have reached that stage where they're now thinking, hey, what are my alternative sources to go and fund? We can help them scale really fast.
And there are many businesses out there like that.
There's many businesses out there that reach 10K. So, I would say actually our average customer probably is around 200K of monthly sales. And we have some customers who are doing 5 million of sales a month. So, we're servicing this broad range of people, but yeah, there's hundreds and hundreds of businesses out there that are doing 10K of monthly sales. So it's possible.
Cool. Thanks.
You can do it. Someone else? Anyone else? There's a big, strong hand there.
Hello. As someone who worked for a company that took uncapped money, I have a question about... Hi.
Hey there.
Oh my gosh.
We had a great experience, but I had a question about what happens to companies who continue to make revenue, but suddenly hit a moment in time like Corona, where that is starting to really impact their bottom line. What are the opportunities for them? Do you have some kind of leeway? And what are the worst case scenarios?
Yeah, well, this is actually the beautiful thing about revenue-based finance. So the way revenue-based finance works is that we're taking a share of your daily sales until you repay the principal and the fixed fee. So in the case of Corona, if your business slows down, your repayments slow down. And even if it goes to zero, so if you're not making any revenue because you've decided, hey, I want to shift my strategy and do something else, the repayments stop. And so I really believe it is the most affordable, efficient way. It's the most flexible way that a founder can actually raise capital now.
I'm just going to ask a quick follow-up because I'm annoying. But there's a difference between revenue and profit, right? So if you're hitting a point where your revenue is still growing, but your profit margins are slowing, where do you sit in that?
Well, we're connected to the revenue, so we're not thinking about the profits of the business. Obviously, a business needs to be able to generate profits in order to keep generating cash flow, but our model is totally revenue-based, so it connects to that.
Thanks.
Cool. Hey, great to have you as a customer, by the way.
I left the company, but yeah, it's great.
Awesome.
Okay, anyone else?
There was a question there.
Yeah.
Hey, it's a question for Ahmed. Where do you think that you would be if you had taken VC funding 5 years ago and you were trying either positively or negatively? And if you could go back in time, basically, and you had that opportunity, knowing what you know now, would you take VC funding?
Thanks God we didn't take it. I'm pretty sure it will be much worse. And the main reason for that is we got some term sheets in the beginning of 2017. And we actually agreed one of them as well. Then we couldn't go through this due diligence process because some of the features that we provided were actually they were some kind of gray area. They were not regulated, including crypto, by the way. And the main issue was crypto. So Papara was the first financial institution in Turkey that opened like bank accounts for cryptocurrency exchanges. And like 5 years ago, everyone was against crypto. Like right now, everyone is like, "Oh, we are crypto fans, blah blah. We do our own NFT tomorrow." But back in like 5 years ago, it wasn't like that. So if we had, yeah, it was that VC. If we have done that deal that day, we had to stop our crypto operations, which later made like half of our revenue in the next 3 years. So yeah. That's a simple answer. That was actually something about what I mentioned by compliance, being invested in fintech players before. It was the wrong part of that VC actually. It's still a good and reputable VC in Turkey, but because they didn't have any cryptocurrency or fintech investment before, they were against it and they wanted us to stop our cryptocurrency operations. It could be the worst.
Thank you.
Other questions? Come on, guys. Anyone else? Okay, well, I'm going to ask one final question.
One there.
Oh, there's one? Oh my gosh. Okay, let's give it to that person in the middle.
Hi, I'm Sizzle. Asher, you had some thoughts around strategic investor. What would make a good strategic investor in your opinion then?
So I think one of the things is understanding how much of your cap table they're going to take. So, limiting that and potentially also thinking about when you sign that deal, what are the terms that are included and what rights does that give them? And sometimes between the lines, when you're signing one of those agreements, some of the terms give that investor powers to block certain transactions or certain events, or it might just be that their voting rights would mean that they would have an influence in those ways. So I think having a really good lawyer is really important, and if you're doing any type of fundraising, maybe except if you're doing Uncapped. One of the beautiful things about Uncapped is our legal agreement is 6 pages and is written in plain English because of the trauma that I perhaps had, where I just wanted founders to be able to actually really understand what they're signing. But when you're doing things with a strategic or a VC, you really need to understand what do those terms mean, and they deal in those terms every single day, right? Like that's part of their job. Whereas a founder, maybe you're going to do this once, twice in your lifetime, or you're raising and having to deal with an agreement like that. So really making sure you have good understanding of who they are and what they're about. The other part, I would say, is also just talking to other companies that they've invested in and understanding what are their experiences and, has that strategic actually added the value that they say they're going to add? And, have they lived through in terms of that cycle of being with the company and actually helping them get to that growth?
Interesting. Okay.
Usually when they call themselves strategic investors, they're not.
Hot takes.
Yeah, I mean, you have to be very clear in terms of what value you want from them, exactly what you need from them. And there is a certain level of relationship building that goes up front anyway. And so you know exactly what value you'll be getting from that arrangement. And I wouldn't actually go for a special deal of any kind that gives them, I don't know, IP rights or whatever. You just actually, I always go for a scenario where, I'd actually say, you know what, actually we'll just opt for creating the first term sheet and putting that in front of them, and then starting the negotiations from that point on. Yeah, so I would say that would be the key thing ultimately, because ultimately from the standpoint of a corporate, this is a huge organization that has to manage their reputation. And ultimately, what does have to happen is that they can't necessarily, get into a sort of a bad faith type setup, because ultimately the word will get out, and once people know that they do something, that they're more likely to do something negative or whatever it is to a startup, then fewer people want to interact with them. So I would say actually because of that, a lot of corporates do actually opt for scenarios where they would want to add value. They wouldn't necessarily want to come in with super onerous terms. But at the end of the day, if you've got money from two sources, a strategic investor, the reason why they're strategic is not only from their standpoint, but also from your standpoint. How do they fit in with your strategy? And as long as you've got that aligned, then, and you're very intentional about it, then, there's no reason why you can't have your cake and eat it too.
Okay, we've got time for one more question. If anyone has another question, put your hand up. Okay, cool. Well, I think we will end it there, because I know everyone is excited to go up and mingle and have cocktails. So thank you so much to all three of you for sharing your experiences.
Welcome. Thank you.
Traumatic and positive. Yeah, thank you so much, guys. And thank everyone.